Hello friends, welcome to the September edition of Monthly Viewpoints. Global equity markets continued their rally in August. If we look at the returns in US dollar terms, the US markets performed the best, giving about 7% return. In India, the Nifty gave about 4% returns and was amongst the best performing markets after the US, Germany, and South Korea. Coming to various asset classes in India, we can see that small caps and mid caps outperformed the Nifty in August, and equities also did better than gold. If you look at various sectors, most of the sectors did reasonably well in August. And if you look at the past 1 year, sectors like healthcare, IT, auto, and metals, which are exposed to the global economy, did better. India is running behind the global economy in terms of the recovery, and hence globally exposed sectors have done well. Most of the countries are seeing a V-shaped recovery. In India, we saw that the real GDP growth in Q1 FY21 contracted by about 24%. However, after that, in July, the PMI has improved and is showing an expansion. So there is some positive data to look forward to. For the full year, we are expecting GDP growth to contract by 5 to 6% year over year. Various high frequency indicators do show a recovery, although a few indicators are moderating. So for example, if you look at electricity consumption growth or petrol consumption, those have all improved. However, for example, diesel consumption is moderating. The e-way bill generation and railway traffic has also improved and is showing a V-shaped recovery. Other indicators like four-wheeler sales and two-wheeler sales have also showed improvement and are back to pre-COVID levels. Another positive data point is that the rural economy is doing quite strong, aided by the strong monsoons, which are about 9% above average, and the Kharif sowing, which is already above levels seen last year. Now, coming to the earnings, the economy is expected to recover only by Q4 FY21 and then going into FY22. So for FY21, the Nifty earnings are expected to contract between 5 to 10%. However, we should see a sharp recovery in FY22 with earnings growth of between 30 to 40%. Now, bear in mind that over the past 5 years, corporate earnings in India have been depressed because of demonetization, the credit crisis, COVID-19, and so on. So, although the past 20-year average is about 11%, the past 5-year average is only about 4.8%. So, going forward, we expect that by FY23, we should go back to the long-term average earnings growth of about 10 to 12% for the Nifty. Coming to valuations, we believe that the price to book is a better indicator than price to earnings in the current environment. The Nifty trailing price to book is currently about 2.7, which is at a 10% discount to its long-term average. We have seen a sharp rally in mid caps and small caps over the past couple of months. However, if you look at the longer term trend, mid caps are still 20% below their peaks seen in Jan 2018, and small caps are about still 40% below that peak. So they still have room to rally. Now coming to flows, FII flows have been quite strong in the past 4 months, although the DII flows have been negative. So coming to an overall view on the market, we expect that the global activity will recover sharply, aided by the easing of lockdowns as well as the fiscal and monetary support. So going forward, liquidity will remain high, which should provide a supportive backdrop for stocks. In India also, abundant liquidity from the FIIs as well as that provided by the RBI will support the economy and can likely drive a bull market in equities over the medium to long term. So over the short term, which is the next 3 months, market volatility is expected to continue, but liquidity should provide support. If we take a 1-year view, valuations are quite reasonable and mid and small caps are at relatively attractive valuations. So market can rise to the earlier peaks, which is an upside of 7 to 8% from current levels. But we prefer to take a long-term 3-year view in the current environment, because both the economy and the earnings would have normalized by then. So over a 3-year time frame, we can expect a return CAGR which is in line with the long-term average of 12.5% for the Nifty. So our recommendation is that investors should stay invested, continue their SIPs, and buy into any dip. Lump sum investments can be spread over the next couple of months. Now with that view, we have taken a number of portfolio-related calls over the past month. So we have consolidated our portfolio by reducing the number of stocks held in the funds and increased concentration in top 20 stocks. We have corrected the underweight in a few of the large cap stocks, and we have maintained our exposure to mid and small caps with some moderation. Coming to specific sectors, we have positioned our portfolio to benefit from consumption, especially the low-ticket consumer discretionary segment. We have increased the exposure to auto and auto ancillaries, increased exposure to private banks and insurance, and reduced exposure to NBFCs, increased exposure to telecom, and maintained our exposure to pharma and healthcare in line with a bullish stance from the last year. So overall, we are overweight the pharma sector, private banks and insurance, low-ticket consumer discretionary, pesticides, chemicals and fertilizers, and industrials, as well as telecom and cement. And we are underweight sectors such as oil and gas, IT, auto ancillaries, consumer staples, and NBFCs. We have also taken a number of actions in terms of our investment process over the past few months. We still continue to follow an investment philosophy of diversification and growth at a reasonable price. The sharp fall in the markets provided us with an opportunity to rebalance our portfolio, and many high-quality stocks had fallen to levels where their valuations had become attractive, providing us with an excellent opportunity to buy these quality stocks for our portfolio before the recent rally. In the current environment, we are preferring sector leaders with relatively stronger balance sheets, higher earnings visibility, strong cash flows, and managements with good track record, as they would be the first ones to recover along with the economic recovery. On the other hand, we are avoiding companies with high leverage. Mid and small caps had seen a significant impact in the correction, and they gave us a good opportunity to add some good quality mid and small cap stocks in our schemes before the recent rally. Overall, we have consolidated our investment universe to have a sharper focus, and there is a higher focus on management quality, especially for introduction of any new stocks in our investment universe. We have also tightened our investment process by building in more filters for business quality, management scorecard, and so on. We have also increased the frequency of reviewing stocks, sectors, and macro fundamentals to identify actionable ideas and take proactive action. Thank you and happy investing.